Let's now have a look at Learning Objective 4, where we look at the Statement of Changes in Equity. So we're going to look at the purpose of the Statement of Changes in Equity and how it links the income statement and balance sheet together. Okay, we're going to concentrate on the retained earnings part of the Statement of Changes in Equity. Basically, what we're looking at here is we want to look at what our ending retained earnings balance is. So to do this, we need to find out what our beginning retained earnings balance is, right? So the beginning balance retained earnings is equivalent to what the ending balance was in the prior period. So once we determine what that beginning balance is based on last period's ending balance, we add on the net income we generated for the period, or net loss. We deduct any drawings or dividends. So that is what owners have taken out of the business and distributed to their own personal accounts. That gives us our ending retained earnings. So basically what we start with, how much we increased that by according to our profit, how much we took out based on our distributions to owners, gives us our ending retained earnings, right? So this is a fundamental part of the Statement of Changes in Equity because this is the most frequent change we see in equity. So essentially, we're looking at how our profit has changed the balance of retained earnings and how distributions to owners has reduced that retained earnings balance, right? So this is the most common area you will see in the Statement of Changes in Equity, and it essentially is reflecting on a change in the equity position of the business. So how much retained earnings is kept by the end of the period. Now, what is the ended retained earnings for January 31, 2020 in this case? So if we look at what they started with, so they started with, on the 1st of January 2020, nothing. They generated net profit of $965. The owners withdrew $731, so in terms of drawings or dividends, and they had total liabilities of $200. So at the end of the month, on January 31, what is the ending retained earnings balance? So please answer that question now. Okay, so here it is. This is what the Statement of Retained Earnings looks like, which is part of our Statement of Changes in Equity. And we can see on the 1st of January, we started with nothing. We generated $965 in profit. We withdrew $731, and we're therefore left with $234. So what's missing? What's missing is the liabilities of $200. That is not part of the Statement of Retained Earnings. That liability is captured in the balance sheet. The balance sheet summarizes all our liabilities. The liabilities have nothing to do with our retained earnings, all right? So they are not included here, okay? So this is the correct answer. The correct answer is $234 in retained earnings at the end of the period. Now, linking the income statements and balance sheet together through the Statement of Changes in Equity is one of the key things that shows us the flow of the statements and the correct sequence of preparing those statements. So we start with the income statement, which we calculate a profit of $965. We then look at the Statement of Changes in Equity over time through taking into account not only the profits, but also the drawings, giving us our ending retained earnings. Those ending retained earnings are included as part of the equity section in the balance sheet, so the retained earnings section, to give us our correct total liabilities and equity, which matches our total assets. Okay, so whenever you're preparing these financial statements, you always prepare the income statement first, then you can prepare the Statement of Changes in Equity to determine what your retained earnings are. And if there are any other changes in equity, you also need to reflect that in this statement. So if there are any extra contributions, for instance, from owners, then you can prepare your balance sheet. Okay, so that's the three key financial statements we've covered so far today.